Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today we can do an update to the Las Vegas real estate market.
Woohoo.
We got all the newest data. If you like data, charts, and real estate in Las Vegas, then subscribe to the channel and you can watch all our videos, keep track. We do these about it every week. Every week we get new data, we go over it. All right, anything else before we get started?
It's beautiful in Vegas. If you're not here, then you have to be here because it's in the low 70s. It's beautiful. And if you are here, get outside and enjoy sunshine.
Yeah, it's late February. It was a super nice day today. Anyway, all right. So we'll just start off here. We'll just throw the first chart up here. This is the real-time market profile for Las Vegas. Now, everything that you see happening right here, we're going to go through them, but this is pretty normal for this time of year. So median list price, you can see that over the last, in each one of those little ticks you see is a week. It's a change of the last week. So median list price is the highest, 565. It's actually the highest it's ever been. Median price of new listings, 533, 450. Price per square foot wanted 278. That is a record. That is, why are we using price per square foot and not the median sold price?
Because that's more accurate, right? Because the rest of the prices depend on the mix of homes that came on the market, that sold, that went under contract, that sort of thing. But price per square foot, it really speaks to the market on a much broader sense. And it gives you an idea of what's happening. It's easier to track trends that way too, because it's not subject to the mix of homes that are selling.
Yep. The average and median days on the market have peaked and declining. We have a whole chart. We're going to talk quite a bit about this. That's the biggest lagging indicator that we have. The second biggest lagging indicator we have is actual price per square foot. And we'll talk about that when we get there. And then inventory is still kind of on a slight decline, which is normal. Rent pretty stable at 2,300. And it says down there, slight seller's advantage. Pretty much, will you agree with that? Sellers have a slight advantage?
They do for those properties that are not choice properties. Okay. Choice properties are still selling quickly, and some properties are getting multiple offers.
Okay, here's the inventory chart. Now this is a smoothed out chart. It's averaging in the inventory in the market. You can see that normally we have a pretty steep decline every year of inventory. This is actually a normal amount of inventory. That, if you see that hump where it was 2020, end of 2022, that was a little artificially high. And then the other years was a little artificially low. But Juana, what's interesting is we've had 3 years now of 6% plus interest rates. And we were told all kinds of crazy things about what was going to happen in real estate, and none of it happened. And first thing that would have happened is people would have tried to sell their homes and they wouldn't have been able to find a buyer. But what's happening? Why are we not seeing that?
So we're not seeing that because the number one thing that I hear from sellers is, I would put my home on the market if there was something for me to buy. I'm concerned that if I put my home on the market, I'll be homeless because there's nothing out there for me to buy, which speaks to the lack of inventory that you just brought up.
So let's say we get a scenario, doesn't matter what city you're in, interest rates go back to, say, from 6% and change to 4% and change, right? That doesn't mean home prices are going to shoot up, because back in 2022, everyone called, like a lot of people called for 40, 50% long-term, like home prices are going to go down 40 or 50%. It has to happen. And it's opposite. Home prices are more just like we said they would be.
Right. So it's a different scenario. So the reason home prices are more now is because supply and demand, we have more demand than we have supply. Now, to your point, if interest rates go in the 4 and change range, are we going to see prices shoot up? And the answer is yes. And the reason we'll see that is kind of that whole fear of missing out thing that we had going on in the spring of 2020. We're going to have two things. We're going to have people who want to take advantage of the lower interest rates, so they will want to come into the market. And then we'll also have the people that were already here looking for a home. So they'll be even more motivated. So you'll have more buyers chasing, again, less homes than we have to satisfy the buyer demand. So when you have that, you're going to have multiple offers. You're going to have people paying probably more than they would otherwise have paid because of the interest rate that is bringing more buyers into the market. So again, we're going to have more buyers than we have today. We're not going to have substantially different inventory. So you will see prices shoot up more.
Here's the price per square foot. As you can see, that little diamond is the same day every this year, last year. So it's like February 25th or whatever. So if you go all the way back, you can pretty much see the home prices have pretty much tracked up. There was that little hump that was artificial. That was just a pump in the market because interest rates were going up and a lot of people were trying to lock in like something under 4%. So they were just overbidding on that. If you just drew a line and took that out, that's kind of what the market actually did. People trying to use that hump as the baseline for, oh, homes are always worth that. And they're, now they're not 20% higher. So something's wrong. That's not true. As you can see, home prices today are higher than they were even back then when it was super artificial. And so it's just kind of interesting. The other thing too is if you look at, you can kind of see the little humps. That's going from spring to fall where the prices tend to drop a little bit. But what other thing is, remember, the bottom of this chart's $150 a square foot. So if you zoom out on this chart, that hump, it doesn't look like it's a big drop. It's only about 8% total. And that's only about 5% more than the normal spring to fall drop, which is usually about 3%. Okay, Wanda, this is the one we're going to spend some time on this. Median days on market. Now, it's peaks in February. It's always the highest month. Why is this the highest month? You would think October, November are the highest month for homes to be on the market. But why is it February?
Well, because February represents the homes who came on the market in the fall, right?
So to explain that, talk through that to them, like explain how that works.
Okay. So the homes that closed in October, November, they went under contract in September, maybe. They maybe came on the market over the summer, right? So that's that pipeline right there. The pipeline that we're working on now, the homes that are closing now, these are homes that have been on the market since October, November. They had to make through the election. They had to make through Thanksgiving, through Christmas, through New Year's. And they got an accepted offer probably somewhere end of December, beginning of January. And now they're closing escrow. So now we're getting these numbers. So that's why these homes have taken longer to sell, because they came on the market at a time when buyers were distracted with other things such as the election, Thanksgiving, Christmas, New Year's, and that sort of thing.
Be careful when somebody quotes a statistic and says, oh, this is what's happening right now. This is a brand new statistic. First of all, the numbers aren't instantly gathered. There's some lag time. And remember, something like this is a 4 or 5 month old number. It's almost completely useless other than this trend you can see. The bottom line is if you put your house on the market today, it's the beginning of March, right? End of February. You probably would go under, if it's reasonably priced and everything, all the other things being equal, probably be under contract in less than 60 days. And you probably would sell and close and all that. But then those numbers wouldn't be reflected for 3 or 4 months because it takes time to actually have a closing and then go look back at the data and put it all together. Now, what's interesting about this too is when you zip down to the bottom of this, we're going to zip over and look at the market segments. Now, what this represents is the 4 quarters of the market. Now, this is for Vegas, but I bet that any market, San Diego, Austin, Nashville, whatever, is going to look just like this, right? The top quarter means the top 25% of all homes that are in the highest that sold. So let me make this easy. If 1,000 homes sold over a period of whatever time, the top 250 would be that top quarter. And then that median price is the middle of the top quarter. So it's basically 1/8 of the homes sold for about above that's 1.3 million. So over 1/8 of all homes, 12%, 12.5%. So over 1.3 million. That to me seems like San Diego numbers, right? Like if you had a house in Linda Vista and it was 1.3 million, but it's not. This is Vegas. The other thing too is that 390. Remember, that's only 12.5% of homes were below 390. The median actually is in the high 500,000 range, 550 to 570, which makes sense when you look at the 2 other quarters. The other thing that's interesting about this one is that days on the market. It's a little more for higher end homes, a little less for smaller homes now, but you see a lot of ultra high end.
Right.
So a lot of those numbers aren't even counted? Why are they not counted?
Right. So the ultra high end is not going to show up in any of these statistics because these statistics are pulling from MLS data. They're not pulling from, for example, the tax record. Okay. So a lot of ultra high end homes. So I'm going to pick on JLo, right? If JLo wants to sell her home, it's not going to be on Zillow. I can guarantee you that. Okay. They value privacy. So those homes are sold off market. Because they're sold off market, they're not reflected here. So even when you're looking at the luxury market here, you're not looking at the ultra luxury market. So I would say, what's the ultra luxury market? So that's a fair question, right? So I would say the ultra luxury market is something in the range of 10 million and above. You will see homes between, just under 10 million, on Zillow and MLS and that sort of thing. It's not that frequent that you'll see homes that are 10 million above on those. You will sometimes, but more often than not, you won't. Those people, like I said, they value privacy, and those homes are sold off market. The other thing is, remember, there really aren't that many buyers for those homes. So there really isn't a whole lot of point to putting them on Zillow or on the MLS, because who's looking at them? I mean, everybody's looking at them, but not everybody can buy those homes. The people that can buy those homes, they know who to contact and who is connected with homes like this and who can get them a home that is of that caliber.
The top quarter of the market is mostly cash. The bottom quarter of the market is mostly cash. Most of the financing is in the middle two quarters of the market. Why? What's the phenomenon behind that? Who are the people buying the bottom end, the high end, and then the middle, and why does that drive whether they pay cash or get a loan?
Right. So the people on the bottom end tend to be investors. So investors want to maximize the use of their capital, so they will, in this interest rate environment, that they'll go ahead and pay cash. The top end, same kind of thing. They want to maximize the use of their capital, and they'll go ahead and pay cash. Everybody else in between is more sensitive to how their cash is used, and maybe they don't have as much liquid cash.
Okay.
So they're more likely to choose leverage, which means borrowing money, in order to make a purchase.
Demographically, the middle of the market are workers. They're people who have jobs, either by themselves or with another person, and they earn income and they desire to own a home. The high-end people are usually wealthy. They're either business owners, celebrities, or just people with a high net worth. They inherited a bunch of money or whatever. And then the bottom of the market is, just like you said, a lot of those are renters. They're rental homes, and there's renters in them. So, but that really hasn't changed. I mean, I bet if we went back 50, 60 years, you would find that same phenomenon. The top of the market's like super rich people. The bottom of the market is a bunch of rental houses. In the middle of the market, just people with jobs trying to, buy something.
Exactly.
Okay. That was the last chart. What are you looking at in the spring going forward? Like, what's a good time to sell? Like, if you have a house to sell, when's a good time to put it on the market?
Whenever it's the right time for you. I mean, honestly. Okay. Everybody will tell you to time the market, and I'm going to say not so much. What you need to time is your own life. Okay, that's the most important thing. Everything else will work itself out. And just kind of to wrap up what you said about cash purchases. Nationally, when we're looking at cash purchases, about 1/3 of homes at any price point, right, nationally, are purchased cash. So that's a lot of cash out there that is being allocated to real estate. And the reason that's important to you and I is because homes that are purchased cash are going to support the value of everybody else in the marketplace, because they're not subject to things like job loss, relocations, things like that. These are very solid investments. So they go to support everybody else who may run into difficulty. So that supports the value of everybody's property.
If I can find the Fred charts, I'm going to put them up. But there is more than twice as much cash held by households than there was 5 years ago. And when I say held by households, we're talking about money in your checking and savings accounts, money, dollars, not in like a brokerage account, right? Cash. Money in money market accounts, and then money in CDs and things like that are getting some rate of return. The number total cumulatively is like 17 trillion. Now, remember, all the homes that sell in a year combined is only 2 trillion. So it doesn't take, you can see that it doesn't take a lot. And I'll bet if we looked at the total dollar amount, it's a third of all home sales, but it's probably 40% of all of that 2 trillion is probably the, so it would be like 800 billion is paid as cash.
Right. So just to give you an idea, on an annual basis, it's like 4.3 million homes sell in the U.S. And now convert that to how many of these homes are sold for cash. So now you're looking at what, like 1.3, 1.4 million homes are sold cash. So that gives you an idea of the support in value that that all of our homes have. So it's a good thing.
This is why I'm going to go back and put up this chart here with prices. You could see, if I had told you back in 2021 that in 2025 interest rates would be not 2%, but like between 6 and 7%. And then to guess what would happen to home prices. And then I showed you this chart, you would have said, there's no possible way. Interest rates go from 2% to between 6 and 7, and home prices could go from under $200 a square foot to over $275 a square foot. Not possible. But it is possible, because we're not talking about bonds. That's how a bond works. The price of a bond is inversely correlated to interest rates. Interest rates go up, your bond is worth less, right? Because why would I buy your bond at 3 or 4% when I can go buy a bond that's 5 or 6, the higher percent bond, right? Real estate doesn't really work that way. Not really. Affordability, it's an affordability factor, but it is not literally demand.
Right.
Right.
Okay. So that was fun. Hope you had a good time with the video. Please remember to like the video, subscribe, hit the notification bell, share the video, leave us your real estate related comments, and we'll see you on the next video. Bye.
Bye.